Good morning, everybody. Good afternoon now. I'd like to call the Finance Committee meeting to order, please. And I understand there are 3 public speakers, please. And the first one is Murray Bowden, followed by Gene Russinoff and Bill Henderson. Here's your list, Doug. Sorry, we just called the public speakers.
Morning. This is a indicating change, and Chairman Saul, this has mostly to do with you, because you and I've disagreed with many of the things that gone on in the years. Well, as an individual, that was but at this time, it's necessary for me to work with you in the MTA. And anything that's happened in the past is in the past, and we go forward. So this is to indicate that we live in a different economic climate than we did in the past, and we have to make different kinds of decisions based on different kinds of information. We need to plan from here on what's the best in the best economic interests of our area. And I look forward to working with various people in the MTA, different parts of it. I've at past meetings asked to meet with people from different groups. It's not my responsibility to stand up here and say what's wrong. It is my responsibility to meet with staff to work through issues. And for anybody to stand up here and just to tell you what's wrong with you without having a solution or a suggestion isn't acceptable in this economic climate. So that both the board and the operating staff need to know that in this economic climate, things are going to be different. There will be pain in certain areas, and certain people will find themselves retired because of technology, because of changing things. We need to be aware of what works today, how we plan for the future, and to coordinate, because electronically it's easy to coordinate. How do we best build an infrastructure for the future? I understand that Cornell University is going to build a information technology center on Roosevelt Island. That's looking to the future. That kind of change is vastly different from New York City. And how do you, as staff members, as board members, build on that infrastructure for the next 20 years?
Thank you, Mr. Bowden. Next speaker is Gene Rushinoff from the Strap Hangers Organization.
Good afternoon. It's clear from the recent special session of the state legislature that the fate of the riding public is in the hands of Governor Cuomo and the state legislative leaders. First and foremost, the leaders, along with the governor, cut $320 million for your operating budget from the MTA payroll mobility tax. And if not restored, these funds could have a drastic impact on your budget, your operations, the fare, and service. Governor Cuomo and the legislature have promised to make the MTA whole in the upcoming state budget. In the law they passed has specific language saying any reductions in transit attributable to reductions in the payroll mobility tax shall be offset through alternative sources that we included in the state budget. And Governor Cuomo has reiterated that promise, saying the money would be replaced dollar for dollar. The riding public is counting on these pledges being kept in 2012 and in the years beyond. Hopefully, the new subsidy in the economy will both grow over time. Many groups are also disappointed that Governor Cuomo and the legislative leaders used the special session to effectively nullify the provisions of the lockbox legislation that was overwhelmingly passed by the state legislature. As with replacing the lost PMT funds, the riding public is counting on Governor Cuomo and the state legislature to put the raids on dedicated transit taxes to an end. Thank you very much.
Thank you, sir. Our next speaker is Bill Henderson of the PCAC.
Good afternoon. I'd like to join Gene in his hopes for the full funding of the MTA under the recent agreement, and remind the governor and the legislators that we'll be watching them as well. I'm here today to commend some of the proposals that have been made to add some modest service restorations to the current budget. We know that the financial situation out there isn't good, and the budgets are tight. We've seen some of the recent revenue projections that are falling short of their original projections. But the mission of the MTA is to provide transportation services for the region and its people, and to do that, it relies on a $12.67 billion budget. Some of the proposals that have been made are to establish a relatively modest $20 million service restoration program. That's $0.02 billion. There are places where people are hurting, where the riders are hurting, where they had service before and they don't have it anymore. These proposals will not restore all services that were cut, but it will provide some necessary funding to restore some of the most egregious situations. Lack of service not only impacts the riders, it impacts the economy as a whole. I ask you to give the proposals for service restoration a fair shake, to listen to them carefully, and to consider their actual impact on the budget, not in terms of what they might mean as a symbol, but what they mean in truth. I mean, we're talking $0.02 billion in a $12.67 billion budget. Thank you.
Mr. Chairman, that concludes the public speakers today.
Okay, thank you very much, Doug. First order of business today is the approval of the minutes of the November 14th Finance Committee meeting, please. Motion? Second, please. Please. Please? Okay, all in favor? Minutes are approved. Doug, the committee work plan?
There are no changes for the work plan for this year. We only have, today, obviously, in 2011. We have a report and information item for your review, which is a draft of the 2012 Finance Committee work plan. We invite you to look at it between now and next month, and if you have any recommendations for inclusion, we'd be happy to consider that. There are two new items relative to prior years. In March, there'll be the MTA Real Estate, MTA Corporate Compliance will present the all-agency real property disposition guidelines and all-agency personal property disposition guidelines. And the second item is in December. MTA Treasury will present MTA and TBTA reimbursement resolutions for federal tax purposes. So, again, we look forward to you reviewing this, and we welcome any comments.
The next order of business is the Finance Watch. Pat?
Thank you. Finance Watch begins on page Roman numeral 4-1 of your committee book today. We have our final new money transaction of 2011 to report on. This was a $500 million transportation revenue bonds 2011D. The bonds were priced on November 29th and 30th, and everything closed on December 7th. And this was led by one of our MWBE senior managers, Ramirez and Company, together with Loop Capital Markets, serving as co-senior. We did something a little different on this transaction, and it's described here on Finance Watch. What we've been observing some dynamics in the retail order periods that were giving us reason to question whether or not we were seeing the full interest of investors in the bonds, and so we slightly amended our order rules to allow a competition among all investor classes for the bonds, and the way we achieved that was by just advising the market that we were only going to allocate 50% of the bonds to retail and the remaining 50% to institutional buyers. What resulted, we think, was a very good outcome. We were able to reprice very aggressively, both after the retail order period and then finally after the institutional order period. Those adjustments were significant and meaningful, and as you can see if you turn the page to 4-2, we achieved an all-in TIC here of 4.57%, which compares very favorably to our existing transportation revenue bonds outstanding, average life of 17.16 years. And then the rest of the statistics are there for your takeaway. Happy to take any questions on this. Okay. A couple other things to report on. I want to get back to the committee on some matters that were raised last month on fuel hedging. And Mark and Chuck, I know you were asking whether it might be more cost-effective to hedge a part of our fuel supply using forward delivery agreements for physical delivery rather than the ISDA-based hedges that we've been using. So we spent a lot of time speaking with New Jersey Transit, and that's exactly what they do. And in fact, they use the same provider as us, Sprague. In addition, we met with their energy advisor, spent some time with this person last week to dive into the details of how they run their program. They develop their budget in a very similar fashion as the MTA. They use forward curves for heating oil, which is, again, highly correlated to diesel fuel. Then they work with their outside energy advisor to monitor market conditions using forward curves. Again, the same forward curves that we use. And then what they do is they'll lock in forward delivery if it suits their budgetary guideline that they've set. And they shared their data with us. What we found is that their added cost to use this strategy adds about a nickel per gallon onto the price of the fuel, the insurance cost, if you will. What we've seen in comparison on our ISDA-based hedges, which are competitively bid among 3 pre-approved providers, is we pay about a half a penny to a penny and a half per gallon. And those are across all the hedges we've executed. So we think our strategy is very efficient and a good way to do it. One of the things you'll note in your budget adoption materials for Wednesday is a brief inclusion of fuel hedging in the staff summary that will continue our existing program on a no more than 24-month basis, but ideally, as we discussed last month, we would lock in on an 18-month basis for a portion of our fuel need, again, using that $100 million fuel hedging account that's been established for this purpose. Just to give you a sense of where we are, the budget's been built around an assumption of diesel at about $2.99 per gallon. And rather than being opportunistic or watching the market, the goal is to have a periodic, regular approach to getting into the market with our fuel hedges to allow us to hedge up to that $100 million amount on a periodic basis, again, coming in about once a month, once every other month, to lock in a portion of fuel for the next 18 months. So we'll never be fully hedged. We'll be about, again, depending on prices and what happens in the market, we'll be about 40% hedged once we ramp up to the full amount.
I just wanted to make sure that everybody got their questions answered, because we did spend a lot of time at the last Finance Committee meeting in November, and I want to make sure everybody's comfortable with this and that it will be included within our, within the budget when we approve it. Is that okay, everybody? Okay. Go ahead.
Okay. I want to just raise to your attention there's been a significant amount of rating activity on banks that some of which we have in our portfolio. Since November 16th, there have been rating actions by either one or two or all 3 agencies that have affected 8 of our different banks: Bank of America Merrill Lynch, BNP Paribas, Dexia Bank, Helaba, J.P. Morgan, KBC Bank, Lloyds, and Morgan Stanley. We are, at the moment, the most severe of these situations has to do with Dexia, which we currently have about $990 million exposure to in our various, across 4 different facilities, 3 in Triborough, 1 in DTF. We have already issued an RFP and we're working on a plan of finance to address all of that debt. The others we're watching very closely. There are no triggering events that have caused us to want to unwind those deals more rapidly than what I just discussed on Dexia. But again, it's a fluid situation, and we're watching it, and we'll keep you apprised of what happens on that. Lastly,
just one thing, I think, and I said to Pat before, I think the Eurozone banks, and I don't know this for a fact, and it hasn't happened, but I think you got to be very concerned that the Eurozone banks, because of a lack of dollar funding and the Basel III Accords and all these things that are coming up, I think a lot of that is going to disappear, and I told Pat we really ought to start, preparing ourselves.
And we are, and we'll have a more detailed update on how the year 2012 will progress. We're laying out all of our finance plans next month in our 2011 year-end summary, and part of that includes a look to the year ahead. So,
Mr. Chairman, if I could ask a question, what does preparing ourselves mean?
Just what he's doing here in this accord. He's got a new bank, Bob. Maybe
Yeah,
you should speak
what we
to this
have
better
is we
than
have
I
a
would.
schedule. We know exactly when every facility comes due, when it expires. We know how much it is. Those that are problematic, we're not waiting for them to expire. We're laying out a plan of when we'll replace them. Some might be replaced by another bank. Some might just have the whole facility and the underlying debt replaced with another strategy, be it floating rate notes or something else. But no, we've got it all mapped out. We know what our exposure is, and we're just proceeding along to take care of it.
So if I understand you correctly, one of the options may be selling debt to replace that debt.
Or finding a new facility
Right.
to replace that facility, or taking the facility out either with fixed rate bonds or floating rate notes or some other mechanism that doesn't require a letter of credit or standby
Letter of credit
facility.
from that bank.
Yeah.
that's right.
Okay.
And we would achieve those changes in every case where possible with a remarketing, so we avoid the state bond issuance charge that would come with a refunding. The distinction being a remarketing and a refunding being very important there.
I think Chuck was next, and then Freddie.
I just have one caveat. Since nobody rates the rating agencies, although they should, I worry that you place too much emphasis on what they say, as contrasted with, and I know you will pay attention to this, as contrasted with getting some of the data, because there are a number of European countries and a number of European banks that are at least as solid as ours. I think you ought to think about that.
Yeah, one of the things we use as the measure is how the underlying bonds with that letter of credit or liquidity trades in the marketplace. And so we're able to see, is it trading on par with other, comparably rated or comparable securities, or is it trading with a big premium? And that's really an indication of what the market thinks, and that's more important to us really than what the rating agency think in many regards.
Freddie?
In paragraph 2, background and discussion on page Roman V5, the second sentence, it is management's intent to take advantage of the proposal put forth by the bank consortium to maintain the existing bonds in a bank-supported variable rate mode. One, what is the dollar consequence to us of that, positive or negative? Two, how does that differ from the current relationship? And three, how would it differ from other similar relationships we have in a fixed rate mode?
Okay, so sure. If you look on Roman numeral 4-5 of your committee book, what you see there are the rate resets for all of our variable rate bonds in weekly mode. And you've jumped ahead to a staff summary that we're coming up to, but
If I've anticipated it,
no, that's okay, because this is all in the same vein. If you look at the two bottom sections, if you look at the TBTA 2005 B2, you see the J.P. Morgan remarkets, the Dexia bonds, and you see that column of rates. And we provide the trailing 6 weeks of rate resets here, and you see how the rate resets have ranged from 1.75% down to 1.10%. A lot of variability there. There's two other transactions down below, TBTA 2003Bs and the 2005As. Again, you see those rate sets kind of in very unattractive relative to other better trading banks in the market. So your question is, what are the dollar costs to us? We haven't measured the dollar costs. We can do that. You see the rates, though, are what.
So you don't have an answer now?
I don't have an answer for dollars. What we can tell you is we expect a significant improvement in the rate reset from these three series of bonds in particular that staff summary speaks to. And
Okay. I had a couple of other questions. But
okay.
Relative to later?
No, I can. So relative to fixed rate bonds, we just sold Triborough bonds, refunding bonds in the market about 8 weeks ago, and we can compare this to that. I think the all-in TIC on that transaction was around a 4% number, and well, actually, we do have that in here. That transaction, the all-in TIC, I'm sorry, was a 3.59%. So we would expect to achieve a better result than that. Again, variable rate bonds take advantage of the short market interest and really are suited to 2A7 money market fund buyers that buy the bonds and hold them for a period of time. Transactions that are working really well, if you look here, if we'll just focus on Triborough, the 2005 B3s with Bank of America, letter of credit on there, the most recent reset on that was 0.17%. So if we compare that 0.17 to the comparable rate on the Dexia bonds, 1.75%, there's a significant improvement that we would expect to get by going this route. Now, 80% of our debt is in fixed rate mode, so we have a bias towards fixed rate issuance, and we'll continue that rather conservative approach. To the extent that we've got a quality book of variable rate bonds in the market, we'd like to keep that because it does provide a low cost funding alternative. It's just heavily staff intensive. It takes a lot of time to stay on top of this. When
do you think we'll know what the dollar consequences?
Well, you never really know till it's over, right? The bonds stay outstanding for 30 years. So what I can tell you is that
rely on your projections.
Well, we have projections. We can look at historically how variable rate bonds have traded over time, and again, if you look at your staff, or if you look at the committee book in Roman numeral 4-9. Every series of bonds outstanding is listed there, and as well as in the far right column, the TIC. For those bonds that are variable rate bonds, what we're presenting is cost experience to date. And so for a variable rate transaction, and again, I'll go back to that example that I just gave you, the 2005 B3s with the Bank of America facility. If you look at the Triborough section, 2005B, there's four separate series of bonds. That's been at 3.56. So slightly better than what we did on the fixed rate, but keeping in mind that we've had about a year now with gradually increasing cost from those Dexia facilities that are in there. So again, I think once we take those out, we would expect to see an improvement. It's always a moving target, and we report that every month here to the committee. So.
I'm sorry.
It's always a moving target, but the fact of the matter is that the variable rate market, if you can meet its basic entry requirement of credit enhancement from a bank that's not about to go bust, or is not perceived as about to go bust, is at the moment and historically tremendously much cheaper than fixed rate. And to the extent you think you can sustain the risk of occasionally having the rates reverse, which historically has happened from time to time, I mean, this is a place we should be carrying as much debt as we think we can manage, as, yes, the cost is uncertain, but historically, at least, and it certainly doesn't appear to be changing at the moment, it's significantly cheaper than fixed-rate debt. The city actually spent a lot of time a year or so ago looking at, over the last 20 years, each time we borrowed money, if at that moment we had borrowed variable rate as compared, what would it have cost us to now, as compared to if we'd borrowed fixed rate at that date, what would it have cost us to now? There wasn't a single instance of the variable rate actually costing more than the fixed rate. This question of bank credit support, however, is very touchy. I mean, it's not just that the cost of that credit support has gone up, which, adds on to what you're paying in the market. It's literally the question of whether you can obtain it. And as what we've been talking about is the credit support is generally not as long as the nominal maturity of the underlying debt. So if the bank disappears and you can't replace them with something, you have to do something else. And the default position is basically you refinance at fixed rate, which, is likely to cost more money.
Everybody forecasts. Just want to know what the basis of our forecast is.
Yeah.
Thank you.
Pat, can I just ask one question?
Go ahead, sir.
Do you have a standard policy on call dates in your bonds?
I'm not sure I understand the
Well,
question.
many of your bonds have a maturity date, say 20, 30 years out, but
Right.
you have a right to call it at an earlier date. Do you have a policy in fixing that?
Well, we have when we issue fixed rate bonds, we always issue with a 10-year par call. I would just note the one exception is when we've issued Build America bonds. Those have been issued with a make whole call provision, which is a slightly different call provision.
The second part of that is that the item that Commissioner Ferreira referred to on V5. Are CalPERS and CalSTRS acting there as security enhancement?
Yes.
Do they have their own shares of problems at CalPERS?
No, they've been in the marketplace for a number of years. They kind of were quiet for a while. Now they're back. They have a rating. They have plenty of liquidity, if you think about it, because as a pension fund, they have many long-term obligations outstanding, but they do have to have liquidity there to meet current needs. For us, frankly, I think it's a very attractive, option, and it helps us to diversify the marketplace. So we have another name out there that we can use. And again, they have an obligation to keep their pension fund funded at a certain level, which therefore means that they do have to provide, strong creditworthiness underlying. So we're quite pleased to see them in the marketplace. We'd like perhaps to see if the state of New York would consider doing something like this as well.
Bob or Pat, I guess, if we're on the U.S. Bancorp, what's their rating? And then maybe if you could just give me a sentence on what is the exact relationship amongst the CalPERS, CalSTRS, and the U.S. Bancorp? Have they split series? Are they all together on each series?
Sure. Well, for U.S. Bank is rated AA2, A+, AA.
Yeah.
So, right. So the proposal has come in with U.S. Bank, CalPERS, CalSTRS. Each bank will have its own obligation on the bonds. Again, on these Triborough bonds, there's $540 million that we're going to, replace Dexia with. We have not broken up the structure in terms of which entity, how much each entity is going to have, but each entity has a finite exposure that they've come to the table with that allows us to remarket all three transactions with the new providers. And so we'll report on that once we've gone through our negotiations and structuring.
We should move on because we should move on now. Pat, is there something? Go ahead, Mark. Make it the last, because we got to do the budgets and everything. I'm afraid we'll go. You sure? Go ahead. We got a minute. Say it. Do it.
You know, this whole question of how the pension funds get into the credit support business is, I mean, as I believe that the structure of that relationship is that they basically set aside a certain portion of their portfolio, so that the fact that they may or may not be funded in terms of their pensioners is really not the issue. It's a question of whether the securities exist that they can set aside to assure the backup on their credit obligation here. For them, it's actually a way of effectively increasing their yield on that rather conservative portion of their invested portfolio. So it's actually a good deal for them. And in terms of this marketplace and the problem with the banks, if that source could become more routinized, frankly, I think it would be a good thing for people like us.
Point well taken.
Thank you.
Pat, is that Finance Watch, or is there anything
That's
else you
Finance
need to
Watch. The
report?
last thing is just to let the committee know that there's a new report that Moody's just issued this morning. I'll just, and this will be emailed to the full board later. I'll just share the title with you. MTA's operations could be strained by reduction of New York State payroll mobility tax. Again, that's just an update from Moody's on state action, and like all rating reports, this will be distributed to the full board for your information. And that concludes Finance Watch.
Okay. Now, the next item is the budget adoption materials. Bob, are you going to take us through that? Or?
Sure.
Yeah. And then we also have the capital plan right after that.
All right. Thanks, Adrian. Everyone has the budget adoption materials in front of you. What I'd like to do now, though, is to just go through a brief summary. You have a handout in front of you. We'll go through some slides that captures the major changes in this document, and then after we have a chance to ask questions, we'll come back to this because it entails the recommendations that we'd like to make. Let's just start with a familiar chart for you. This chart lays out the November operating results. This is what we talked about last month. As you recall, the November plan gave us near-term balance, but we identified a number of significant risks. We were projecting $179 million of operating cash balance at the end of 2011. Now, that cash balance was to be rolled over into 2012, where we had a comparably sized deficit. And basically, between the two, we ended up with a break-even projected. A $96 million cash balance projected for 2013, rolling that forward into 2014 to address the deficit there, we had a continuing deficit projected of $122 million. And then in 2015, we were projecting a deficit of $206 million. The risks that we talked about last month are the risks that we talked about in July, and we've talked about at other times. A worsening in the economy. Is there going to be a double-dip recession? A reduction in state subsidies or dedicated taxes? Can we hit the expense targets that we've laid out for us, which are aggressive? Will we fall short in our 3 net zeros labor settlement? And will we be able to fund the 2012 to 14 portion of the capital program in front of us? Well, you can see what I've identified here in red. That's the issue that we're now facing. We had further discussions with the Division of Budget after the November plan came out, and our discussions with them suggested that the MMTOA monies, again, that's the collection sales tax, business taxes, surcharge, a little bit of PBT, for next year should be about $87 million lower than what we had in the November plan. We looked at it, and about $58 million lower in 13, and then 45 and 47 lower than what we had included in the plan in 14 and 15. On the plus side, we did look at MTA aid, and we saw that it looked like we'd have about $13 million more in MTA aid coming in this year and $7 million a year projected going forward. Now, the MTA aid is those revenues or those fees that we were given at the same time that the PMT was put in place. It's auto rental fees, it's license fees, it's a taxi cab surcharge, and basically this is coming from the auto rental fees, which is 5%, and then the taxi cab surcharges. We had higher than projected there. So the net of those, it's positive. Now there's one tax that I haven't put up here, and that's the PMT. And we know with the exemptions of the PMT that we're projecting, and the state is suggesting, that it'll be about $310 million a year reduction in PMT. Now it doesn't kick in until April 1st. So roughly for this coming calendar year, we're expecting to see about a $212 million reduction in the PMT. Now the December Act, the December legislation says that they will use alternative funding sources to make us whole. So for this purpose right now, we're assuming that it's neutral. But again, if it is not, that's an issue for us.
What parts of the PMT? I've seen everything that a reduction of the PMT and make whole. What parts of the PMT did
They exempted, I think, any payroll with less than $312,500. I think there was another between $312,500 and a higher amount that was 11.11%. They had a higher amount that was 0.23 or 24%. And then they excluded not just the school districts. Remember, the school districts had to pay in the past, and then they were reimbursed. Now they've exempted the school districts. They've also exempted parochial school and certain other categories. So basically, we've gone from a place where people were not subject to the tax, but they were asked to pay it, which would have been better for us, and then they were reimbursed. Now we're being asked to be in a mode where people have been exempted, and we're to be made whole or reimbursed for the lost revenue. We are at risk, yes. With that, how does that affect our financial plan projections? Well, the lower subsidies result in a $67 million 2012 deficit and increased out-year deficits here. You can see, again, side-by-side bars. The dark shaded bars are from the November plan. The hash bars are those from the December plan as we go forward. And you can see, again, that we went to a negative 67 projection for next year, reduced operating cash balance in 2013, and a significant increase in deficits in 14 and 15. So what are we proposing to do to mitigate, these lower revenues? Well, the first thing we're going to do, if you recall, we still had $8 million of our general reserve left for this year, and we were holding on to that perhaps to protect against winter storms or things like that. At this point, we're talking about just rolling that back into, this year's operation, so that will increase our cash balance. We increased the general reserve from $100 million, which is what we've done for the last couple of years, to $125 million for next year. And one of the reasons was to cover this kind of situation. Well, we're immediately going to take $25 million now out of the reserve to try to offset the lost revenues from the MMTOA. We also are planning on having, as of yet unspecified, but recurring annual expense target reductions of $35 million a year. We are working on a plan right now. We're trying to identify what those will be. We have ideas, but it won't be until next year that we do identify how we're going to save the additional $35 million, and then that'll get incorporated into the July plan. Those things together, when you compare them, you have the November plan and the December plan, and while things have changed, we're still to a situation where, while we have a higher cash balance now for this year, it's necessary to meet the increased deficit for 2012. We have slightly less money in 2013, and about a $19 million deficit increase in 14, $5 million deficit increase in 15. One thing that is happening, while it looks like we're still, kind of in the same place, we're not just fragile, we're even more fragile, because we've started to use up some of the reserves that we had built in for this purpose. So if we use up reserves, if we have to go to further cost increase or cost saving increases, it just means that we have less flexibility in the out years. Andrew wanted me to just mention something. Sure. The $200 million that we're projecting now, where did that come from? How did we end up with the $200 million, which is a very good question. And let me just, in rough numbers, because again, these aren't audited numbers now. These are numbers that we think, and we'll have to see how they turn out. But our revenues between the February plan, the budget last year, and the December plan, our operating revenues are down about $47 million. But our operating expenses are down about $210 million. I mean, that shows you the effectiveness of the cost-saving program that the board has adopted in prior budgets and the actions that were taken. Subsidies, primarily real estate, is about $46 million higher than we had in the plan. Debt service, based on the budget, is about a $94 million savings. So this year we had lower debt service costs by about a $94 million based on favorable variable rate, based on favorable long-term fixed rates in the marketplace, and timing. About $135 million was used, however, to pay back the GASB loan. And again, we have money, GASB accounts for voluntary contributions, which we've set aside to cover retiree health care costs. That money has been used in prior years to provide an internal loan. This one was for the TA, where they borrowed in 2010, $135 million to be repaid at the beginning of 2012, and so that money has just been repaid. Was taking place right now. And then there's just some little odds and ends, maybe about another $30 million of a combination of things. But all told, that gets you to roughly the $200 million balance we have. But I do want to emphasize it's the $210 million worth of cost savings, which is really key. It's critical, and that's what we want to continue to do, and we don't want to backslide. I would just end with this chart saying the risks do still remain. All of those risks that we saw in the very first chart are the ones that we have to pay attention to. We can't do anything about the economy, but we can try to keep our eye on the ball on expense reductions. We've got to continue our focus with our labor negotiations, and that's what we're committed to do.
Do you want to do the capital and then take questions? Or do you want to,
Yeah, let's take questions now.
on the budget?
And then we'll take the action, and then we'll go to capital.
Okay, great. Okay. Chuck, go ahead, please.
Are you comfortable with intra-agency loans where you're borrowing from pension and trust funds, particularly the trust funds?
Yeah. We're not borrowing from pension funds. That's not out there. And the trust funds right now have not really been put in trust. We've collected the monies. We have a trust established, but we have not put the monies yet in trust. We're comfortable enough because we know we can get the money back. It's not like a long-term investment, but they are not trusteed monies.
And you have, from Jim or anyone else, comfort that we're okay doing that?
Yes.
Okay.
Yes. Yeah, these are not trusteed monies. These are not anything that we're taking out. These are cash accounts that are there for us. We disclose them monthly. And part of the board package or budget adoption package that you'll be seeing and voting on later does authorize certain borrowings, but the borrowings have to be repaid within a certain period of time depending on what they are. So that's one of the things that we try to be very careful about.
It was that additional piece that caused me to be bothered as to whether or not you can lawfully do that. Let me suggest that you double check with Jim and his staff to make sure you're comfortable on that, please.
Okay. Other questions? Yes. So if you would turn to Roman 1-4. And just to make sure we've covered it, I will kind of read through this section. Okay, Roman 1-4, the recommendation, it's recommended that the board adopt the 2012 final proposed budget and four-year financial plan 2012 to 2015, the December plan, which includes approving 2011 final estimate, the general reserve, and all plan adjustments, items below the baseline. To authorize staff under the guidance of the executive director to take actions to implement the subsidy and other technical adjustments set forth in the December plan. To authorize technical adjustments to the agency budgets and forecasts of a non-material nature in the February plan. To authorize adjustment of agency 2012 budgets and forecasts to reflect labor settlements approved from time to time by the board. To authorize the transfer of certain Long Island bus staff temporarily to MTA HQ to continue wind-down work necessary to close out Long Island bus operations. To authorize staff to continue its previously authorized energy hedge program and authorize forward hedges up to but not exceeding 24 months in duration to always assure 1 full year of price certainty for the hedged amounts. To approve additional budget and cash management actions as has been done in past budget adoptions, including advance of bridges and tunnel operating surplus, uses of MTA MRT2 corporate account monies, uses of payroll mobility tax and replacement funds and other new taxes, to authorize the executive director or his designee to enter into interagency loan agreements, the use of the stabilization reserve, and to make Government Accounting Standard Board GASB contributions of $58 million as set forth in the 2012 budget, with additional contributions in the out year of the plan. So that's
Okay,
the recommendation.
Right, so we can take that as a motion, right? So we have a motion, please, and we need a second? All in favor?
Mr. Chairman, if I may,
Yes.
I'd like to make a motion to amend the budget before we vote.
Okay.
We'd like to authorize the reallocation of $20 million included in this budget for service adjustments to be given to the operating presidents of the TA and the Long Island Railroad and Metro North, to be used to reauthorize and reallocate, reinstitute some of the service adjustments which were eliminated in the last allocation. And I do this for two reasons. Wait, if my motion is not seconded, amendment's not seconded.
Second.
I do this for a variety of reasons. Part of which is looking at this chart, which is, I guess, still up there, or almost still up there. We are assuming in this five-year operating plan, that we will have fare increases in 2013 and 2015. Those are included within the plan, and the numbers so reflect that. We have a cash allocation at the moment. In a $12.6 million budget, it is very important to me that we allocate some portion of those funds, $20 million, which Mr. Henderson has indicated is less than 0.2%, whatever it is, for this purpose. And the reason for that is because this will be, if you look at that chart, the last opportunity we will have, most likely, between today and 2016, if the assumptions are correct, and we're all to assume they are to some degree, to provide some relief back to our commuters and our transit users to increase service, or to put back some of the service which was reduced. Because looking at that chart, we clearly will not have that opportunity again, and we will therefore go through 3 fare increases without in any way changing our service lines. That to me is not fair to our users. It does not provide the fiduciary responsibility I believe I have as a board member to our users. And this is in no way indicating that we do not have concerns. We obviously have concerns. Anybody listening to Bob's report will understand we have concerns. But notwithstanding that, we owe a duty also to our users to provide them with the service which is necessary. And I think providing some small portion of opportunity back to our operating agencies to restore some of that service should be part and parcel of this discussion and should be part and parcel of this budget, and that's why I make the motion to amend the budget. Thank you, Mr. Chairman.
Okay, so, excuse me, we have the original motion, and now we have an amendment to the motion, so we will have to vote on the amendment first and then go back to the original motion. So anybody that wants to speak on the amendment should do so now before we have a vote on the amendment. Is that clear? Is that acceptable?
Thank you, sir.
Right. First speaker is Mark.
You know, I think that we're all very much concerned about the fact that our business is providing transportation for people. We painfully reduced our operating cost with some impact to service. We have a current level of service, which we're doing our best to maintain, as was just pointed out, as you look forward in terms of our fiscal circumstances, it doesn't look particularly secure or safe. If you put back the $20 million, it's not just putting back the $20 million for the next 6 months or something. I mean, as a reality measure, it needs to be $20 million ongoing, which means that next year the cumulative impact is 40, the year after that it's 60, 80, so on and so forth. This is in the face of a budget where we're assuming that our labor force effectively contributes 3 flat zeros to us in the next contract, that the state of New York replaces tax revenue that they've just removed in terms of their own resources to take care of us going forward, a loss in revenue that already has, I'm sorry, the unspecified cut was $35 million going forward this year, which, I mean, as far as I know, is a blank slate in terms of how we're going to realize that value. I think that under our fiscal circumstances, notwithstanding the fact that I too would be extremely happy if we could add back service, the idea of doing so as we currently stand to me makes no sense. This is not a game of adding it back for 5 minutes and taking it away again. I mean, responsibly, for us to add service means that we can see that we're going to sustain this level of spending reliably going forward, and given our circumstances at the moment, I don't see that.
Alan, I think you're next.
Yes. In support of the amendment. First of all, I think what Mitch and I are looking to do here is not add a single dollar to the budget. We're not asking to increase our obligations financially one bit, not by a nickel. Okay, what we're seeking to do is reapportion some of the money that we've already got in the budget for other things and apply it towards direct services in those areas that were hit hard and for which Mark himself says he would like to restore. I still have in my mind, as I'm sure many of you do, the voices of the people in the public hearings that we attended, some of these 6- and 8-hour public hearings, and the pain that for them, I mean, for us it was psychic pain. For them it's real pain of having to lost some of the services that are provided out there, a bus route that's relatively nearby with reliability, and in some instances their only way to get around. What this motion seeks to do is essentially affirm my faith in Linda Kleinman and Charlie Monheim and the wonderful job that they've done in essentially pulling $1 billion out of our operating budget over the last several years and almost $4 billion out of the proposed capital budget, and simply saying that we think we can go beyond that another 300 positions, that we can move for somewhere between 300 and 350 positions from non-transportation related services into people who drive buses or move trains and provide services to our riders. You know, additionally, what this money would allow, and thus far I have great faith in Tom Prendergast and Darrell at buses, some flexibility in dealing with populations that we haven't even served. I can't tell you how frustrating it is to me to have to find zero growth solutions to real problems. I've got college on Staten Island. It's got 13,000 people that for 4 years I've been trying to get a few dollars added on so they can get a bus service that's in there, and I've been denied, that opportunity. There are buses, there are express buses in some instances that need to be relooked at. And I'm not seeking to right here negotiate specific services, but I could name services from the Bronx 41 to the Queens 79 and 74 and go around the region and talk about services that really need to be relooked at. Together with the Long Island Railroad's Port Washington branch, which service there needs to be done. As Mitch has correctly said, one of the frustrating things to me about this, and I talked about it 2 years ago when we cut it, and I said that we need to be vigilant in trying to relook at this issue and restore, is there is no plan to, no institutional mechanism to deal with this. We've come up with a purported plan to deal with the capital program over 5 years, okay, which quite frankly is far riskier than what Mitch and I are suggesting here and far more fiscally perilous, relieving the burden from the city and the state to undertake that. But there's no institutional memory or institutional process for dealing with services for our riders. And we are a transportation agency. We're not a bank. While we have fiscal responsibilities, and that has to guide us in all of this, we also need to create an institutional mechanism to deal with restoring and providing services for our customers. I look at the mayor and the governor, and I see what they've done with their with the agencies, and they've provided more with less in many instances, and things that they should be commended for. And I believe that we can do the same here. I believe that we can provide more service and get leaner in certain areas. Why do we have 5 or 6 legal departments to handle torts? Something I mentioned the other day at a discussion that we were having. There are other areas in terms of design and other functions that we could consolidate and be looking to put into direct services. So, again, we're not looking to increase it $1. We already have positions that are in place that have reoccurring costs that are going to go on for year after year after year, so there's no multiplier effect. What I'm saying is let's redeploy some of what we have into actually providing direct transportation services for our customers. Thank you.
Paul?
Yes, I really appreciate Mitch's ideas and also Alan's and what they're trying to do and to make people feel good. But I think this is a terrible time to start something like this because everybody's issue is tantamount to them. And you're going to have people knocking down your door. The press are going to get a hold of this, and they're going to say we're mismanaging money. We don't know how much we have. We don't have. They're giving away to this particular party who needs. Everybody needs the money. Every organization that I know does. And if you start giving a little bit of it away and say this is a feel-good thing, everybody's going to see right through that. They're not going to get what they want, everybody. And you can't just pick one person like a favorite son and say we're going to give you this, everybody feel good, aren't we great? People aren't looking at people as being great right now. And if things turn around even worse than they are right now, which I don't see any reason why they're not, and here we are giving away money, this is going to blow up in everybody's face. So I'd love to do it, and I think that Mitch and that Alan have a great idea of doing it. I think it'd make everybody feel good for a minute, but it's going to turn around, it's going to be a disaster.
Andrew?
Yeah, I'd like to commend Commissioner Pally and Capelli on their well-thought-out plan. It's a wonderful thing to not be the only one at the table advocating for more service for a change. Look, all you have to do is look at the Transit Committee and Bus Committee books every month to see how ridership on the buses has continued to decline. It's declining because of the cuts that were made on June 27th of 2010, which rendered lots and lots of bus lines virtually unusable. I know people that have told me, I used to ride this bus. It doesn't go where I want to go anymore, so I'm not using it. And these are self-fulfilling prophecies. This isn't about feeling good. It's about restoring much-needed services. We've just renovated the Atlantic Viaduct to the tune of $90 million, and we're running trains 6 hours less on it. We just, at every committee meeting, you hear people, and the public hearings that Commissioner Capelli referred to, it was just heartbreaking. This is such a drop in the bucket. It's, you know, as Alan said, it's about reallocating money that's already there. Anybody that got a look at this financial plan sees that money is shifted from one area to another, and PAYGO capital continues to take up a lot of this, and you have to be concerned if that's all going to be made good to the operating budget. We can't keep attacking the operating budget as we have been and expect nothing to change. You know, people have a tendency to hate the MTA. If they got a little something back for their next 3 fare increases, I don't think that's too much to ask. I really don't. I'm not going to repeat all the points that everybody else made because we're running out of time here. But, I think this is something that should be done. I think it's a rounding error in the whole scheme of things, and it really would help people in their commutes. It helps the economic activity of the city as well. Thank you.
Jeff?
I'll be quick. I don't want to repeat what everyone has said, but I guess a couple extra points. One is what I think we sometimes forget is the amount of work, and I don't think it was anyone's intention of all the savings and work within the organization to save the services that are already there. Have some of the non-transportation savings, I think that's what I'm looking for, not been made. There might have been more cuts that had to be made. So I think there's been a lot of work. And I think that the administration is doing everything they can. And if there was $20 million out there within the organization that can be rerouted elsewhere, I think every month we come here we talk about that. And in fact, is being rerouted just to save the services that we have made. And then my second point for the moment is on the actual service cuts. We went through an exhaustive review of the service cuts and how it actually impacted those riders, and in fact, in some cases, in some points to my dismay, but in some cases, transit has in fact reversed some of those services because it fell within the parameters that could be done without board approval, that could be done because in fact there was a real impact. They might be small, but they do have a real impact. So I don't want this conversation to go unsaid that there is in fact quote-unquote fat within the organization. Everything that can be saved I think is continuing to be saved, and we are doing what we can, while on the margins there are some service changes that have been made in the meantime. And then I guess my last thing I said before, and I said this I think 2 years ago when we had this conversation, is I think Mark sort of mentioned that we can't be in a position of while we have a very short cash surplus right now of putting it in, taking it back, because I guarantee you if we had the ability to spend the money now for the next year and a half or so, we'll be right back at that table again. No one wanted to make those service cuts 2 years ago. No one wanted to reduce these people's services, but we had to, and we'll be in that position in less than a year. And I wouldn't want to be in the position of giving it to them and taking it back. We should be honest with our riders. We should be honest with our financial situation and honest with the future of the MTA, which frankly is in some financial jeopardy, in my opinion. I should recharacterize that as being risky.
Chuck?
Mr. Chairman, I don't think there is a rider in the system that doesn't believe that we need to restore service or that the cuts have been beyond the pale. There are, however, over the course of the next 3 or 4 months, at least 3 major facts that will develop one way or the other, in all likelihood at least. One is whether or not we receive the $310 million in the budget. Second is whether or not the executive directors, as I understand it, plan to consolidate and thereby try and achieve both efficiencies and savings will be able to be effectuated or at least put into play. And 3, the fiction of the 3 zeros, which I believe is there for bookkeeping purposes, but you know where my prejudices lie. Having said that, it seems to me that perhaps this is an issue that we ought to put aside until we know whether or not those possibilities become real. We need to restore service, but we have 3 open issues at least that we won't know the answers to for a couple of months. And is that the time to take a look at it? And is that too late to take a look at it? I don't know the answer to that.
Is there anybody else? Jim?
I, on behalf of the riders, also want to associate my sentiments with Mitch Allen, Andrew, and just enhance it a slight bit by saying that I think it's important that we lay down a marker and tell the agency presidents that this is where we want your attention to be placed, and make it happen, because the people who we represent have been ill-used as a result of some of the unfortunate service cutbacks that were necessitated in the last round of budget cuts, and this is a way to do that.
I like to think that our agency presidents, the main thing that's on their mind is their customers. And I don't doubt for 1 minute that that's true. And I also think that that based upon what I know, and that is that if they find there's an area that needs service, somehow they can maneuver what they have to provide that service and take away from someplace that isn't as successful or needs service. So I think that I don't think we give enough credit to our presidents and their administration, because I think that as they do business every day, they run across these things long before we see them. And if they can change something without going to the board, as Jeff has said, I think they do that as a practical course of doing business. But I don't want to leave in anybody's mind that the primary concern of our presidents is our commuters. And to leave that on the table would be hurtful.
I certainly wouldn't want to suggest that I assumed or wanted that to be assumed. It is just giving the agency presidents in a sense, a green light, or at least a yellow light, that they can look creatively and positively in that area.
Andrew?
Yes, John, you're next. Sorry.
No, that's okay. Go ahead if you guys
No, go ahead.
Okay, thank you. I agree conceptually that if we could afford some service improvements, I wasn't around last year when you went through the decisions at the board, but I'm here now and I do understand what went on. And if we can afford service improvements, we should strive to do so. But the recent tax data that we just got the update as recently as this meeting show a worsening budget situation combined with a new sentiment of Albany that they will replace over $300 million that they have actually taken away. So the money's been taken away subject to future action, which is the subject of a pledge that it will be replaced. But there's some risk there. So I don't see how we can, in good faith, make a addition to service that we may in fact have to take away pretty quickly, and that would be the most erratic and unfair action of this board to do. So I think perhaps we need some more specificity and some more transparency on some specific, which will take work and time, which we just don't have in front of us and can't have in front of us today, on what perhaps crisis service improvements need to be addressed, and maybe there's a way to find that money. But clearly that information, that specificity is not in front of us, and the only thing in front of us today is a seriously worsened financial condition that should not be aggravated by board action today. Thank you.
Fred?
I can't vote on these two issues at this meeting. I'll get my chance on Wednesday if it comes to that. But I can attest to the fact that waiting for the BX41 will add years to your life in a few short months. Waiting for the BX10 is a pain in the neck. That said, I don't want us to ignore I wouldn't want us to ignore what Mr. Merdler suggested a moment ago. And that's because we're relying on the governor and the legislature to make us whole. We as a board to say, okay, we found $20 million and we're going to fund some unspecified service restorations. One, if we're going to vote for that, if I'm going to vote for that, I want to know what those service restorations are and where they're going to be. But even beyond that, we're sending a signal that give us $20 million less because we found it. I don't know that we found it. And I don't know if it's honest to say that. Now, I associate myself with the board members who have suggested that we ought to be about restoring service. I believe that's what we should be doing. I hear people complain to me all the time. I pay attention to the public comments. You see drops in ridership on buses. That should concern all of us as stewards of the system. But I think we've got to be very careful about, at this stage, adding money that sends an unwarranted message to those who we're holding responsible, and everyone's holding responsible, to keep us whole, that we may not need all of that money. I think you can't send mixed messages at this very perilous time in our budget. But I want to reiterate, I think Mitch and Alan are absolutely right. We've got to be about restoring service at some point. We've got to find the means to do that. It's why a lot of us ask, what is this going to cost? What does this benefit us? What does this save us money? What'll this cost us in additional funds? Because we're trying to get a sense of where we can reallocate and redeploy resources. But we're going to have to get to that point at some point. I don't know if this is the point.
Okay, I think everybody's pretty much spoken. Before we call for a vote, I just wanted to say a little something that the way I feel. I think that first of all, when you restore service, it costs money, Alan. I don't think there's any way to think that you're going to be able to restore service without having it go to the bottom line of the MTA. And everybody here wants to restore service. I think everybody said that. This thing, like Jim Sedor said, I agree, this is about serving our customers. But the other thing it's about is being fiscally responsible. And as Bob showed you, and everything that you read in the newspapers about the economy and the city and the state and everything else that's going, Europe, everything else that's happening, I think it would be a disastrous time to send a signal that there's money here to add service to the existing service that we provide our customers. And I think fiscally, this can always be looked at in the future, and I think it should be looked at in the future if times change. But at this moment, with this budget and with what's happening, I think it would just be suicidal, really, to add service here. And I certainly would tend to vote against the amendment. So with that said, I'd like to call for a vote. We all know what the amendment is. I believe it's clear. I want to caution there board members that do not have a vote, please, and board members that are not on the Finance Committee, please do not vote, because it's only actual Finance Committee members and those members that have a vote. So all in favor of the Mitch Paley and Alan's amendment? That's two. You got two. And all opposed, please?
7 votes.
Right.
1 collective vote.
Right. So the amendment clearly fails. The next vote is for the actual proposed budget that Bob presented to us. I think that's clear, and there is a
Andrew,
motion.
I have a
Yeah, I'm
question
sorry.
on page, I don't know when I get a chance or if now's the time, page 1-5 under the uses of payroll mobility tax. I have a question. Is now the time or later? And the budget adoption materials.
Oh, so now, before we take the vote, why don't you?
Yeah.
Yeah, go ahead, John.
Okay. In the paragraph uses of the PMT, authorize, second line in the middle, the board authorized that the revenues from the PMT be released as needed for pledged revenues by MTA to secure and be applied to the payment of bonds to be issued in the future. Is this creating a new security, a new structure to issue new bonds, or is this just to take this money and use it for our existing structure?
To answer your question, there's no new resolution contemplated, John. The funds are, in effect, captured by the transportation revenue pledge until the board takes specific action at a later time to pledge them to a new credit. So
That's what I thought. I just want to make sure I wasn't doing something other than that. Thank you.
Question, if I may. Is there any barrier to this resolution that just failed being reintroduced 3 or 4 months from now when we have greater certainty?
No, I think that, as we
I just
said...
want to be sure that
No,
there
as
isn't.
I think, look, this is an ongoing living thing, the MTA, and I think as we go along as commissioners, we want to relook at the situation and the budget. We always have a mid-year budget in July, which we do, and I think this has to be looked at again. I said that. I just don't think now's the time to do it.
I just wanted the record.
Right. Okay, so we have a motion. Is everybody clear on the motion? It's our budget.
Andy, yeah, I'm sorry. I had a question and a comment. My one comment, I said earlier, and I understand the sentiment of what we just dealt with, but again, the timing of the replacement of the PMT money that is now no longer available to us is of great concern to me. And Pat mentioned there's some new rating agency report out today. I haven't seen it, heard about it, or read it. But it would seem to me at some point the rating agencies and the bond market, broader bond market, will get concerned if clearly given the sentiment of what was passed in Albany and the statement of the governor are probably sufficient for now to show that they want to do a dollar-for-dollar replacement. But over time, and there's no magic date, but over time, that promise needs to be delivered on, because at some point in time, the fact that there is missing revenue will really be apparent and could jeopardize a lot of things, including our bond ratings and other things. And I know that as it gets closer to budget time on April 1, first of all, I think there's only been one on-time budget in the last whatever number of years. But in addition to that, there could be a lot of linkage in things, and it's very important to us as an entity that we get this dollar-for-dollar replacement enacted ASAP before it affects our bond rating or any other thing, and before it gets mixed into what may or may not be a late budget. Thank you.
Joe, you would like to say something?
Yes, the legislation that passed the legislature last week and signed by the governor goes into effect on April 1st. The reduction in the PMT goes into effect at that time, not earlier, it wasn't retroactive, wasn't as of that date. It's effective April
no
1st.
retroactive. Okay,
That being said, I fully, I appreciate your concern about an on-time budget, because that's exactly where the amounts will be, and looking forward to the executive budget that comes out in the third week in January.
Great, and thanks for the clarification on the effective date. Thank you.
Okay, so now we have our budget, motions made for our budget, and a second, please. Okay, all in favor of the budget? Opposed? Would you mark that? You got it, Jim? Okay, budget is passed. Okay, so the next item, Linda, you're up on deck here for the capital plan.
Okay, I'm here to talk to you about the proposed 2010 to 14 capital program amendment, which was submitted to you in a separate document that has a staff summary and the amendment itself attached to it. So when we were here last talking to you, we said that the capital program amendment would be coming in January, and here we are in December. So let me explain to you that change in thinking. The last week, as you all know, the governor and the legislature kicked off the conversation about the importance of investment in infrastructure to the regional and state economy, and in particular to the creation of jobs. And as all of you know, whenever we've talked about the MTA capital program, it's always been in the context of how important it is to regional state economy and the creation of jobs. So the feeling was that it was important to have our capital program up in Albany for consideration while this discussion was underway to reiterate the importance of the capital program to jobs and to the regional economy. You may remember when I've reported here to you in the past, I stated that the New York Building Congress has estimated that a fully funded MTA capital program in 2012 would account for about 25% of the regional construction jobs. We estimate using a model that the fully funded program creates over 300,000 direct and indirect jobs throughout the state, and these are important catalysts for consideration while people are thinking about how to spur the economy. So the first thing in creating an amendment as to how to fund the last 3 years, and remember that's really the only issue on the table here is funding the last 3 years, as the entire 5-year program of projects has already been approved. So the way to start this discussion, in our view, was a discussion of the self-help that we have built into this program. So you know when we resubmitted the program in 2010, early 2010, we took it down by $2 billion by looking at new ways of doing business and ensuring that the projects that we were putting forth were just the priority projects. And we are now, and we promised at that time that we would look to continue to deliver on those savings. And in fact, this program, the last 3 years, proposes that we do just that, and we are proposing, and it will be work, and it has been work, we've already started on these efforts, to reduce the program by another $2 billion, much in line with the kind of work that's being done on the operating budget, to challenge ourselves constantly to look at how we're implementing these projects to ensure that we're doing them for the least expensive cost and delivering the benefits that they're meant to deliver. So the program that we put before you is a program that's been reduced from $26.3 billion to $24.3. And you all know that the CPRB program is a subset of that. CPRB does not approve the Bridges and Tunnels program. So the CPRB program was a $23.8 billion program, and the proposal is to reduce it to $22.2. So what are some of the initiatives underway? I've spoken to this committee as well as to CPOC about many of these. One is to try and increase the productivity along the right-of-way. About 30% of our work is along the right-of-way. It includes track work, power work, station work, a lot of things where the more productive we get, the less that those jobs cost us. And you heard at a presentation at the Transit Committee not that long ago about a line segment closure program that Transit is planning to do that would greatly increase the ability to get work done on the right-of-way and should reduce our costs tremendously. Another initiative that we have underway is looking to reduce the cost of rolling stock purchases. This will be important for buses, as the last 3 years of the program have about $1.2 billion worth of bus purchases that are expected, and it will be important for the M9 purchase, which for both Long Island Railroad and East Side Access is a purchase of over $1 billion. We also have moved very aggressively into a component replacement project in lieu of total replacement of the asset. We're doing a lot of that work in stations. For those of you at CPOC, the discussion of track also has involved how we can move to replacement of components of track as opposed to pulling out the entire track. We're also looking very carefully at how we can reduce the costs of capital program management. You all know, I believe, that we took a 15% reduction on administrative positions in capital program management, much like we had done on the operating budget. In addition, we have several initiatives that we plan to be reporting on to CPOC to lower those costs further. We're looking at overhead rates. We're looking at process reviews, and we're looking to determine the best, if you will, consolidated way of thinking about capital program management, whether it be in-house or third-party or the right combination of the two. And finally, we have a process underway that we've also talked about called GATES, which requires that we actually take a hard look at a project before it enters a critical milestone in its life cycle to ensure that it is in fact being proposed at the least cost, and that as it moves forward it continues to promise delivery at that lower cost, and that the benefits remain the same. So those are the initiatives underway. There may be more that come up if the board has suggestions here, and the goal is to achieve, again, that extra $2 billion worth of a reduction. The core program reduction, which is about $1.6 billion, with about almost $400 million of a reduction attributed to bridges and tunnels. But the core program reduction has been applied to the core agencies by shares. And then we've taken about a 10% reduction across element totals as an interim placeholder. We suspect that the actual reductions will vary from this, and we will use regular reporting at CPOC to report against our reduction successes. And we also have regular reporting for the Capital Program Review Board in Albany by way of quarterly tracking committees. So we will be reporting there as well at our success against these goals. The next two slides I want to show you are what are typically the core meat of a capital program. It's what we call the use of funds chart and the sources of funds chart. So this use of funds chart basically just shows you what the board-approved program was in 10 to 14, what the proposed plan is, and basically what this shows you is the reduction as applied to the different agencies. So you see that it's in total about $2 billion, with $374 million attributed to B&T, and then the rest applied to transit, Long Island Railroad, and Metro North. So these would be the goals that we'll be reporting against as we report to CPOC and elsewhere. Now, for those of you who are at CPOC, you know that we've already achieved several $100 million worth of savings by virtue of largely good bids, some by virtue of these kinds of initiatives that are underway, so that the market is right, and it's a right time now to really press forward with the kind of initiatives that will ensure that the good bids we get continue even as the market begins to tick up. So what are the uses? What are the sources of funds? This chart basically lays in the various things that we've talked to you about as to how we propose funding the last 3 years of the capital program. The first column on the chart is the board-approved plan. The second shows the money that was anticipated in 10 and 11, and you'll remember 10 and 11 was fully funded. And then 12 to 14 is basically what's proposed for funding the last 3 years. The first item on there is the federal funds. Federal funds have been stabilized at 2011 levels, so we're assuming for 12, 13, and 14 that federal funds will continue at those levels. It's somewhat lower than what we had originally anticipated, but that's offset to a large degree by the grant we got for high-speed rail, which is the next 295, and some other ancillary federal funds. We also will continue to get the money we anticipated for federal security. The next line is the $2.2 billion that we've talked about with you for the railroad rehabilitation and improvement financing. That's the RIF loan. We know that the process for the RIF loan is moving forward at the federal level, but we've been told that they will not finally approve that loan until they see that the funding for the entire program has been approved. The feds have indicated they don't intend to be the only part of the solution. They intend to be part of the solution, not the only solution. The next point that I'd like to raise is the city capital funds. We are and have been anticipating, in addition to the $100 million a year from the city, an increase. We've been working cooperatively with the city on some creative, non-traditional ways to come up with that increased contribution, and we believe it's a reasonable assumption for the plan. Similarly, there are $770 in state assistance. Bob's been working also cooperatively with the Department of Budget, and they're looking at how they could make this source of assistance available to us, and we also believe this is a reasonable assumption for the plan. The next line are the MTA bonds, which we've talked to you about. These would be transportation revenue bonds, and you will remember at the last Board Finance Committee we talked about the affordability of the transportation revenue bonds as well as the RIF loan based on the use of PAYGO, and Bob went through the presentation about how that has by using that we have no impact on the operating budget. The other 890 includes $640 million of remaining PAYGO after you use PAYGO to support the bonds, as well as the sale of MTA assets, primarily headquarters buildings and a few other things. So that's how you get to a fully funded 10 to 14 capital program for the CPRB agencies, and you see at the bottom B&T, which self-funds from its tolls. So just a reminder, I don't know how that little bullet went over like that, but just a reminder, the program of projects that are in the amendment are a program of projects that have all been approved. The 5-year program was approved. The only difference I should point out is we have included in that program of projects the Steinway Tubes project that just went to the Transit Committee today, just so that we rationalize the program. The efficiency improvements that I've talked to you about and the financing proposal that is put forth today will allow all of these projects to be implemented. No new revenue sources or taxes are needed, and it has no additional burden on the operating budget. And this leads us to the recommendation that's in the staff summary that the Board of Directors approve the proposal to fully fund the remainder of the 10 to 14 capital program and authorize the proposal to be submitted to the MTA Capital Program Review Board for their approval.
Okay, thank you very much, Linda. Good presentation. We're going to, any comments, of course? Chuck, I think you were first, then Jim's next.
I have two brief comments. The first is I'd like to suggest an additional item for you to add to that list. There are a number of very significant and ripe delayed claims that we have. For example, within Metro North, they have about $15 million on one claim alone that ought to be matured at this time and collected upon. They could probably fall, or possibly fall, in the operating budget to assist there. But we ought to move those forward. The second one is I'd like to take issue for the record with the notion of selling the real estate as contrasted with getting full value through joint ventures and other vehicles. The sale is a short-term solution that at the end, when it's done, you're done, rather than getting money in a practical way.
Yeah, I think I perhaps misspoke. I think even relative to these buildings, we would be thinking of a long-term lease or something exactly for those reasons.
Yeah, Linda, this morning at the Railroad Committee, there was some concern that a 9% hit on all the capital programs and how it came about, and there were concerns that depending upon how the agency projected its first capital project and how close they were, that 9% cut could really eat into the bone of some of the actual capital programs. And we were told by the agency presidents that these were targets. And the concern was that these targets, we would look at them. And I think you answered the question for saying we're going to review these as we go so that no capital program is going to be hurt because of these 9%.
Right. It was, frankly, in a program this big, it seemed to us that a 10% goal, looking as broadly as we are and across the agencies the way we are, was something that was achievable. It's not achievable without substantial work, and I think because it is substantial work, it will be something we will regularly be reporting on. So, for instance, we've reported on the in-house track work that all the agencies are doing, and all the agencies are driving serious change in that work, and that kind of change expands to work that we give third parties along the right-of-way. So I think it's really the same way the operating budget has driven these initiatives and continues to drive them and sees the results. we want to take the same approach. But we are conscious of concerns, and we will be reporting regularly.
So I don't want to make such a big deal out of what I'm about to say, but about a year or so ago, I think I said the paratransit contract of over $1 billion was the scariest vote we've had to take. I think this rivals that, and give me a few minutes to explain why. It says right in the discussion in the staff summary about this capital plan why we're actually at this point. And I'm not going to read it because everyone has heard it and seen it and has obviously read it. But what this basically says is 2 years ago, we prepared a capital plan of about $28 billion. The state legislature, the governor, and Albany came together and said, you know what, we're not going to do the full 5-year capital plan because we are going to come up with an MTA bailout. And that MTA bailout is going to include a whole bunch of revenue, which we've all talked about. And you know what, we think it's only going to last the first 2 years. So we're going to veto this 5-year capital plan until we can come up with a new funding program and come back to us in 2 years with a new funding program. We're now at that 2-year mark. What we've done is cut the capital plan down from $28 billion to $22, $23, whatever it is. And I think that's been an enormous amount of work on behalf of the staff in order to pull some of that stuff out. But what we haven't come up with is a new funding plan because, in fact, it was Albany that said at the time, we're going to veto without prejudice the capital plan because they are going to resolve the funding issues. There are no new funding plans, and there's no new funding revenue in this capital plan budget. The Albany had said they were going to resolve it. It has gone unresolved. So that leaves us in a very, very difficult situation. And last month, I think I said that given that circumstance that we're faced, we've come up with a way that is creative, does as I don't want to use the word minimal damage, but minimal impact in the short term on the operating budget, not necessarily the long term. And I fear that history is going to look back at this time like we did 2 years ago on previous board decisions to issue more debt to fund a capital plan without new revenue. So we're faced with this question. Should we move forward with a capital plan or not, given no new resources? And I think ultimately it comes down to the fact, some of what we've talked about before, the capital plan provides an enormous amount of services to the riders and an enormous amount of services to the system in general, and I think it would be a shame if we didn't move this capital plan forward, because the only other option is not to have a capital plan. What that would do to the economy, what would they do to the services, what they do, frankly, would stop the system. And so I don't want to play political football with the riders in this way. We owe them at least that, but I have serious, serious concerns about this capital plan. I think that this capital plan gets submitted to CPRB with exactly what it says, is we don't have any new revenues, we're funding this with debt, and, if you can come up with new revenues, since we don't have the authority to provide new revenues, that's probably the best way to do it. Whether it says that or not, I think that's what we're all saying. We have no option but to move forward with this on behalf of the riders and behalf of the system because we don't want to look back. But history really is going to have to look back at this in the context that the MTA is trying to do what's right, and the MTA would love to get new revenues. And Albany had said in the past they were going to provide new revenues. The practical reality of that, as such, might be something different. But that's why I believe that this vote should go forward. Very, very tentative and very not comfortable with this, but at the end of the day, that I think is our ultimate responsibility to the system to keep it going, to keep it clean, and keep investing that capital money. But this is going to have some serious, serious impact on the future of this entity and the operating budget of this entity, if not in the next 2, 3, or 4 years, but beyond that. No question about it.
Thank you, Andrew. Just a somewhat technical question about the federal formula. I understand your comment about there being some substitution through the federal high-speed rail, which I guess one assumes we would have had regardless, that we didn't get that because they weren't able to pass this. Just what are the dynamics of essentially giving the federal government a pass on this? We could just as easily, it seems to me, go to the CPRB and say we're assuming that the feds are going to come through with this when the political season's over, and we all wake up happy but if we give them a pass, we're never going to see that money.
So let me explain. The reduction in the federal amount was based on overly optimistic assumptions on our part. So we had, if you remember, when we had first submitted the capital program back in 2009, we had assumed reauthorization was going to happen very early in the plan. And typically, transit does very well in a reauthorization period. So we had assumed a substantial increase in what has been a very consistent federal partner funding. Then it became clear that it was going to take a bit more time, so we assumed reauthorization would kick in 2012. And so we assumed that increase in 2012 and carrying through to 2014. It doesn't, the struggles that Washington is having as to reauthorization. So we felt that and they're talking potentially about a 2-year at current levels. Any number of things have been discussed. So we felt it prudent to assume just a steady state of the federal contribution for the last 3 years. It's still, they're a very, very consistent funding partner. So we've held their levels stable, and we believe that's something that we can count on. The high-speed rail grant, we applied for it. Part of what we're doing in East Side Access at the Harold Interlocking fit the bill. Did we know we were going to get it? No, but it fit nicely. It's work that can happen in Harold soon, and that's the nature of those grants as well. It's those that can be shovel-ready sooner rather than later. So we got that money. Now, if in fact reauthorization happens during the 12 to 14 period and it includes an increase, we would change this assumption. We'll come and let you know that in fact there's more federal money available. But this was our assumption that changed, not theirs.
Well, just the reason I brought it up is because when we did the slide presentation, the change column disappeared, and the $632 million ain't chump change.
No, but again, it was based on our assuming reauthorization and a 25% increase starting in 12. That's based on historically how well transit does in reauthorization.
Can I ask, what's the effect of approval of this plan on the operating budget for the next 3 years? In its current format?
Yeah, none.
Well, none, no, you mean none in addition. How much does it cost us in the operating plan to pay for what we do?
Right. If you recall, the monies that we are using to pay the debt service are monies that are already in the operating plan, but we're going to be used for pay-as-you-go capital.
Right.
So the operating budget doesn't go up. Our total expenditures does not increase.
That
Okay.
I understand. I remember that conversation. My question is, what is the aggregate number in the operating budget in 2012 that we are, in whatever ways we're doing it, that help fund the capital plan?
Oh, and it is $150 million this year, I believe, $200 million the next, and
That's the
$250.
pay-go piece.
That's the pay-go piece.
Now, does that include that include all the debt service?
Yes. Those three numbers
Right.
will be used to pay debt service and to pay residual pay-go. So those are the numbers that are in our operating budget that will be spent now for this plan.
So there's no other
No.
funds that we use to fund any of our debt service beyond the pay-go money?
Nothing for this debt that's here. We have our regular debt.
Well,
that we continue to-
and that was my other question. How much, because the regular debt pays for everything else that we do and also pays for some of this, which we all understand, and pays for 10 and 11. So my question is, what's the amount total that we're using in the budget?
In 2012, it's $2.129 billion in debt service.
And that includes all of the expenses associated with the debt service.
That's really on the current.
In the current plan,
Yes,
right.
yeah,
Right,
that's
I
right.
understand, on
Yeah.
the current plan, right.
Yeah.
And
It's
the
expenses,
assumption is
pay-
that
principal
number...
and- principal and interest.
Right,
Yeah.
and the assumption that number will not change, which is what
that
you're
number
saying.
will not. That's right. What we're doing here with this plan, if you approve it, that number will still be locked in going forward, and it will just be the new that you approved that would be added
But
to
we're
it.
still using about a sixth of our operating budget for debt service and debt service related issues.
Yeah, I think it's about 17%.
Right.
You've got the number.
Okay, thank you.
You're welcome.
Anybody else before we take a vote on this? Alan?
Yeah, I think it's a little somewhat ironic that we're going down this road with this capital plan after the discussion that we had on the amendment, particularly since some of the comments were the concern over the legislature and the governor putting the $300 million into the budget, which actually I'm pretty confident that in 2012 that number will be there. Okay, I'm pretty confident that the governor will make his commitment to this system and the agency. The out years, that's anybody's guess as the state's finances change and so forth. This is an extraordinarily risky proposition, and as Jeffrey mentioned, it's probably the most frightening thing that we voted on. I thought the service cuts were painful, but in terms of long-term fiscal stability of this agency, this plan itself increases our debt significantly, again, without the promise of the revenue to pay for it. I've spoken on this issue, in the past, and I'm not going to reiterate what I said then and what other members said then about the debt that we had. I intend to vote no on this because not that I've got great faith in Linda and the capital program and the wonderful things that she's done there. This shifts too much burden to the rider in terms of potential increases and their share of the fare, which is the highest in the country right now, the share that the New York City Transit rider has to have. And my God, the tolls that we're charging the riders, what this is going to do to tolls, potentially in the long term, particularly if interest rates go up on these bonds, to me is a frightening proposition. I don't know why we need to go 3 years out. I understand the climate in Albany. I had wished that we had gone for a shorter-term solution and gone back to the legislature and the governor. I think that this is an extraordinarily risky proposition. Thank you.
Anybody else? As I've always said, speaking for myself now, I echo what Jeff has said, and Alan, I think that you're going to have almost $40 billion worth of debt on this agency at the end of the next 3 years, which is, to me, an incredible sum. 2019, sorry. Is a credible sum of money for a transportation system. And then when the next capital plan comes up, and that is going to be a really onerous proposition without additional financing from some source. As a matter of fact, I don't think you could even probably have another capital plan without substantial funds coming into this agency. I don't think the fare box or the setup that we have now could take it. So I agree with everybody. But, of course, the alternative is, what is your alternative? Either you pass and send down the capital plan, or you're not going to be able to continue the capital projects. You're not going to be able to refurbish your stations, refurbish your signal systems, all the things we do. So I think this board basically is left with very little choice except to vote for this thing. And unlike Alan, I intend to vote for it because I don't think you have any other responsible choice. But I think this is going to have to be really watched by Joe in the future and the future boards to see where we go with this, because it is certainly an onerous liability on the agency. There's no question about it. So with that, we have the capital plan, and we have a motion. Is there a second, please? All in favor? Yes, in favor of the capital plan, sending it to Albany. Okay. I'm in favor of it also. Yeah, but sorry. Opposed? There's one vote opposed. Okay, so moved. Okay, thank you. The next item on our agenda, back to our agenda.
Reimbursement resolution.
Yes, reimbursement resolution for federal tax purposes. Who's going to do that? Are you, Doug, you're going to do that one?
No.
Pat?
Well, all we're asking is to obtain board adoption of reimbursement resolutions that are required by federal tax law to preserve the ability to finance certain capital projects on a tax-exempt basis.
Yeah. Does everybody understand that? Okay. Yeah, wait, make sure everybody else.
Okay.
Doug, repeat that again. I don't think everybody was
Sure.
listening.
No, this is, if we've used, other than bond money to pay for eligible capital expenditures, and then we issued new money bonds, the proceeds can be used to reimburse the use of, for example, federal dollars or other dollars. So it's the board taking action to reimburse the use of capital proceeds that have come from non-capital sources. Right, I think Vinay should be, Vinay?
Let me just, we would not be able to do it with tax-exempt debt. That's the key here. We want to be able to do this with tax-exempt debt, and so the board has to take action to express that it will, in fact, do, that it's its intention to do this.
Expenditures in the future with bond proceeds? Is that what we're talking about?
No, it's purely a reimbursement issue, Mark. So the best example I can give is if we've paid a capital invoice from something other than bond proceeds, but the intent is to use bond proceeds, and maybe we haven't done a new money deal, and so then you issue the bonds. The bonds then get plugged in to cover that expenditure, and the original money was freed up for its initial intended purpose.
So this is a resolution before us. Do we need a motion?
Yeah, we need a motion, and we need a board approval.
Okay, so we have a motion, please, and a second. All in favor? Aye. All opposed? So moved. Doug, that's moved. Okay. The next item on our Pat,
Pat's gonna take care of it.
approval of the remarketing agent.
Right. So this is at the time that the board approved underwriters, remarketing agents, and swap counterparties in December 2010. That was the result of an RFP. U.S. Bank, as a proposer, had not submitted a proposal. They've since established a significant public finance presence, both in terms of investment banking as well as remarketing capabilities. We've evaluated that. They've got a book of variable rate bonds that they remarket that exceeds $5 billion. They've hired personnel with significant expertise in this arena, and we are recommending that that U.S. Bank is approved as a remarketing agent only. They would not be eligible to sit on underwritings of our fixed rate bonds, but it would just be confined to this purpose that's described in the staff summary.
Okay, so a motion, please. May we have a motion?
Motion made.
Okay, a second? Second, please. Second. All in favor? Aye. Opposed? So moved. Okay, now we go to procurements.
Yeah, we have 8 competitive procurements for headquarters for a grand total of $199,492,849. We have one procurement on e-procurement of office supplies. Charlie Monheim is going to make a few statements about.
Good afternoon. So the procurement for WB Mason and Crystal Info Systems was conducted pursuant to authorization from the board to pilot using something called e-procurement or reverse auctions to see if we could save money over traditional competitive bidding processes. We believe that the initial reaction to this has been successful, And so in addition to seeking your approval for the approval of the procurements themselves, we're also seeking your approval to extend the trial and to ultimately then competitively secure the services of a firm to assist us with the IT aspects of conducting these on a more regular basis going forward.
Just for a point of information, this, I feel, is one of the most important things going forward for our procurement process. It is something that is being used by other institutions. One, for example, that I'm chairman of the audit committee, actually, of is Mount Sinai Medical Center, which is, as you know, one of the biggest medical centers in the country. They have over 40% of their procurements now online, and they are saving a vast amounts of money on this thing. It's incredible. When they started this, they never would have believed the results they got. And Charlie has spent a lot of time, done a great job with this thing, he and the staff, getting this thing up, getting it ready for a test. The Mount Sinai people came down here at my invitation and helped Charlie get it started. And this going forward could be a major, major thing. This is, I know it's just happening here. We've had a long meeting and we don't want to waste, not waste, but spend a lot of time on this thing. But for the future and the implications of an agency that does so much procurement, that his budget is so tight, this is a major thing. Also, I noticed that a lot of the board members have been complaining about the amount of sole source agreements that are happening, and I totally agree with that. I've been in agreement with that for years. Because of the internet, I think you can open up the field so that you get many more bidders. There's many small industrial companies out in the heartland, places we would never realistically be able to touch and get to bid on our work. I think through the internet you will find that you will get a lot of new source, and I think some very qualified people that really want the business and can fit into our picture. So it really can help us on sole source agreements when we get this thing up. I think it'll cut into the amount of things that we don't know where we have possible manufacturers to bid on these things. So I just tell you from real experience out of a major institution right here in New York State, this is a real money saver for us. Okay, that's the speech. Okay,
So we're looking for approval for all the headquarter
okay, so
procurements?
we have a motion. Please, motion made. A second.
These are the competitive, you're doing which one? You're doing the 8 competitive,
all
right?
the 8 headquarter procurements, that's correct.
This does not include the personal service. This is just the 8, right? Through G, I'm just trying to find out what I'm voting for.
1, 2, 3, 4,
There's a
5,
total of 8 under headquarters.
The last one is veterinarian services, that collection, right?
It goes on, it's on page V9 in your book.
To 12.
Through V12, that's
Right.
correct, John.
Right.
So it encompasses 8 procurements.
Right.
When they're all competitive also, I guess, right? It says competitive on
It
it.
goes through V8, Roman numeral 5-18.
Yeah, and they're all competitive.
Yes, they're all competitive.
Okay, so a motion, please. Second. All in favor?
Aye.
So approved.
Okay, next, from the Metro North Long Island Railroad Committee, there are no procurements for Metro North. There are 7 procurements for Long Island Railroad, 2 non-competitive procurements, 5 competitive procurements for a grand total of $107,160,044.
Okay, motion.
Did we do page V-17 yet? That's from, I had the question on.
Yes.
But we did through
We did.
12.
Well, we went through 18, but we can go back.
That's why I asked. All right, I have a question on V-17, if I could. The personal service contract. It says that the MTA, and the word used here is subsidizes the full cost of the dental plan. I guess subsidize means pay in full. The full cost of the dental plan. So there's no sharing of the costs at all by the employee. The employee pays $0.
That's correct.
For the dental. Now, it omits the vision. Is the same
The vision,
subsidy in place?
The vision, I believe, is the same. That's correct.
100%, because it doesn't say that. Okay.
Okay, Johnny, you
Thank
comfortable
you.
with that then?
Well, I
that-
just
is that
want to know the
acceptable?
fact. It is what it is.
It is what it is.
The subsidy equals 100%.
Okay, Doug, go ahead.
Okay. So we're seeking for approval of the commuter rail, Long Island Railroad procurements.
And the Metro North, right?
There
All
were
the
no
commuter
Metro
rail.
North. There were 7 procurements for Long Island
Oh,
Railroad.
just for Long Island Railroad. Okay, a motion,
So
please.
moved.
Second. All in favor?
Aye.
Opposed? So moved.
Next, MTA bus operations. There's one competitive procurement for a grand total of $31,708,339.
Second.
All in favor?
Aye.
Opposed? So moved.
Okay, there's nothing for bridges and tunnel. Next is New York City Transit. It's one action item that Linda alluded to earlier. It's New York City to obtain board approval to add a project to the 2010 to 2014 capital program that'll address electrical and structural work in the Steinway tube. The project's total value is $95 million, of which the electrical work, $65 million, is currently being progressed, with an award projected to be made in January 2012. This project will be funded from program savings.
Moved. Second.
All in favor?
Aye.
Before we, just one thing though, we are going to pull, let's see, what number is this one? 99 is going to be pulled to the next board meeting in January to do further research on it. So this motion that's now pending on the transit item will not include Over Arup, if I'm pronouncing it correctly, Partners and Consulting Engineers. It's a $6.752 million.
Okay. No, yeah, we just, we're looking for, I think we need approval on the action item, and now we're doing the procurement itself.
Oh, okay, so when we get to
Yeah.
that one, Doug, just
That's
mark it. there.
coming right up.
Okay, so now we need an approval on the action
On
item?
the action item?
Okay,
Right.
so motion, please.
I think, okay.
Second, please. All in favor?
Aye.
Opposed?
All right,
So
so
moved.
I guess we have 6 procurements for New York City Transit. We have 7 in the book. I'm not sure, which one was that? That was a...
9-9.
So with the exception of 9-9, we would seek approval on all the remaining ones.
Right.
Second.
Wait, I have a question on 9-7. I think we're there. Are we, Doug, or are we not?
Yeah, that's correct.
The issue that's come up a lot in the Metro North LIRR committee when we have questions on procurements has to do with when a company comes back for an extension or repair, years, sometimes decades, sometimes when I was in junior high school, later, and we're stuck with the entity submitting the request for a new contract because they're the only ones who have the proprietary software. With that as apologize, long lead in. Do we have the same situation where we're going to be stuck with this company for software with this type of contract on 9-7, or does this not include software, the type of which would fall under the problem that I just described? Just pure signals with no, but not something that we're going to have, okay. Not that I know. All right, Counselor. All right, thank you. I got you. Thanks, Doug.
So we have a motion then? Second, please. All in favor?
Aye.
Oh, yeah, there's no items for FinTech, and that would conclude the finance portion of this meeting, and Jeff will take over with real estate.
Okay. Thanks, Doug. Hi, everybody. Long meeting. I had promised you that I would make a report this month, the last of our 4 installments on our comprehensive plan for reviewing our portfolio. I had promised that I would talk about suburban properties today, but I was asked, in the interest of time, to defer that to January, which I will do. We have 8 action items for your consideration, which are summarized in the staff summaries in the book. Be glad to take any questions. I think, without exception, they are straightforward.
Jeff, did I read this correct? Is Central Market coming back to the terminal?
That's correct. The high bidder for they're in a different
Location.
Location. That's correct.
Where is this location?
It's it's on the other side. Right.
Okay. Thank you. That's good.
I was more impressed about the proliferation of bike lanes in Dutchess County.
So we have a motion, please, to approve the real estate leases.
So moved.
Okay, a second, please.
Second.
All in favor?
Aye.
All opposed? No.
Thank you.
Moved. Thank you. Just two information items. One, due to the lateness, we're going to adjourn the security meeting until January. Most of the items on the agenda, if not all, have come up under the committees, the rail committees and the transportation committee. And anything that needed to be voted on was voted on in the finance package that we just approved. So in January, we will hold the security meeting. Okay, now we need a motion, please, to go into executive session to talk about labor issues, please. Second. All in favor? Thanks.